just a few minutes left. We've got about 8 minutes until we are done for the week. Ryan Nauman is back with us, market strategist at Zephyr. Ryan, welcome back to the show. A nice way to close out our show here into the bell. So walk me through how you're thinking about this into the weekend, this back and forth that we've got in the market, and now ultimately a little bit of a risk-off turn.
Hey, Oliver, first, thank you for having me back on. Yeah, I think also leading, playing into today is also, triple witching day also, just to add to some of the uncertainty that we're dealing with after the Fed's pivot earlier in the week that caught some traders off guard. And I do agree, like, with the uncertainty that's out there, that traders are dealing with going into the weekend, that is a risk-off day, and there's just more uncertainty other than just the Fed. You've got some economic data recently that's been missing on the downside that is causing some angst too, that maybe, the best is now behind us.
Ryan, one of the things that seemed like a risk point up until basically this week was that the Fed would stand by and toy with inflation in a dangerous manner. Now it seems the market, as Larry and I were just discussing with bonds, is suggesting that perhaps maybe there could be the risk of a Fed overreach, or that we'll have inflation that's problematic for the economy and hikes. So it seems like there's very opposite things here that are risks. I mean, which one is it? Can we have this narrative where the Fed could be putting us in danger by not acting, and now the Fed's putting us in danger by acting?
Yeah, that's a great point and great question. Earlier in the year, everyone was concerned that the Fed was asleep at the wheel. And then come Wednesday, we found out that they're not asleep at the wheel, and that they are more hawkish than what we thought. And they're going to be potentially aggressive enough to move forward with their tightening earlier than what most expected, and we see the repercussions of that when it catches us off guard a little bit. You get some crazy movements, like you said on Wednesday. Rates rose, and then on Thursday, all of a sudden the yield curve flattens. So I think traders are still trying to wade through those comments. What's coming up? Is inflation stickier than what we think? What is transitory? Is transitory a quarter, 6 months? What's the length of transitory? There's a lot of uncertainty out there, and I'm not quite sure the Fed really helped with their statements on Wednesday. And I think to go along with Larry's point in your earlier segment, that 10 years could fall to 120 or increase up to 170. I think that's what we're dealing with right now.
Okay. So Ryan, in terms of the portfolio management, what are we learning? I mean, there's so many cross currents here. There's convexity, there's circularity. It's just really hard to extract a whole lot this far, only 3 days, except for maybe that the dollar has clearly chosen that it's going to wring out as much strength as it can here from some of the short bets that were piled against it. That to me looks like the most conviction move of the week. So what does that mean for portfolio management and strategy, the way you think about it?
Great question, and I think it makes it very difficult. One thing that makes it difficult too for portfolio managers is correlations have increased between cross assets. So that makes it much more difficult. And I think it's important to, try and stay as diversified as possible. Really focus on your the investor's risk tolerance and time frames, because there's a lot of uncertainty out there, and it's important to stay diversified. Try and increase or decrease correlations amongst asset classes as much as possible moving forward, whether that's taking on alternatives. You see the dollar increasing, which could hurt emerging markets. So you've got that to navigate as well when as a portfolio manager. So there's a lot there. It's a difficult role right now with correlations increasing. And we've seen that earlier in this week between bonds and the S&P. So that's going to continue, I think. And you just have to really focus on your long-term goals and objectives, and stay as diversified as you can.
Ryan, we only got about a minute, but we're looking at the economic surprise chart. The non-U.S. G10 economies as a whole have actually done better. Actually, that also includes the U.S., but that economic surprise rate has remained more stable. I mean, we did get some nice numbers recently here to push that forward, especially on the inflation front. Do you think that there's another leg left for this U.S. exceptionalism theme?
Good question. I think we've seen the best in terms of economic data. I think the peak was, in the second quarter. That's when we saw I think we'll experience the peak growth rate in terms of economic growth, as well as earnings growth as well. And I also think you're going to start seeing some of this economic data start to stabilize and roll over a little bit. You're seeing that in durable goods, retail spending, some other segments of the economy. The economic data, they're not beating expectations. They're falling below expectations. I think that's going to continue as we move forward, and that's going to add, push potentially yields even lower on the long end.
Okay, Ryan, great stuff, and really like the thought here. It's been a complicated week, so the more thoughtful analysis we can get, the better. That helps us. Thank you very much. Ryan Nauman joins us from Zephyr. He's a market strategist, and the closing bell in a minute and a half.